Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Welcome back to Valmika Property Investing. I'm your host, JP Costa, and today we're diving into the world of market cycles and how they impact your property investment strategy. We'll explore how diversification can be your best friend during these economic ups and downs, and we'll unpack specific strategies to navigate different market conditions. So let's get straight to it. Understanding market cycles. So we've all heard the term boom-bust cycle, but what is it exactly? Basically, in a nutshell, property markets and financial markets around the world as well experience periods of boom, so rising prices, followed by corrections, which is price declines. And understanding these cycles is crucial for informed investment decisions. These tend to be dominated by inflation cycles, and low inflation cycles. So as we're seeing currently, we have had inflation come down quite nicely. However, we've reached a floor, and at that floor it's getting a little bit sticky due to service inflation. But in normal periods where inflation is coming down, it means that monetary policy, which is the interest rate set by the reserve banks around the world, is too high. And in times like that, you traditionally get bear markets or correction markets, so we like to call it. And then in times where inflation is low and interest rates get cut, it stimulates the economy, and then we see the start of bull markets. So where we are currently is at an interesting stage. Many economists, the majority at the moment, believe that we're at the top of the bear cycle. In other words, at the peak of the interest rate hiking cycle, so the next move is likely to be down. And as a result, we've already started seeing the start of a bull market. And the reason being for this is that investors who have been sitting on the sideline have got capital to deploy. And because they think the next interest rate move is down, they go in and they start purchasing property with the viewpoint that rates will be going down, so their mortgage will be going cheaper. This is if you're on a floating mortgage, of course. And then on the back of that, more people will be able to afford property and the momentum will gather. So that's why the start of a bull market usually happens just prior to an interest rate cut, and it just accelerates when we get the interest rate cut. And of course, the opposite happens in bear markets. The investors start pulling away, the market starts pulling away because they see the next rate moves will be going higher, and then the market gets weaker and weaker as interest rates go up and the affordability of property becomes less prominent. So statistics in action for you. The average property cycle in Australia and in many places around the world is roughly around 7 to 10 years. And this time frame can vary by location and obviously property type. So this highlights the importance of being prepared for the growth and the potential downturns. So how do we do it? So let's talk about strategies for different market cycles. Bull market. Now personally, I'm torn between the bull market because in the bull market, the ideal scenario to be in is have your properties already in play so that you can take full advantage of the growth that bull markets give you. But at the same time, where I don't like bull markets is when they get too hot. This is where I see many people overpaying for property because they're competing with confidence against others and emotions get in the way, and they tend to buy property at too much of an expensive rate. So during bull markets, we recommend patience and avoiding bidding wars that could lead to this overpaying. And how do you do this? It obviously gets more difficult, but what we like to do is we like to utilize our network. So we've got an extensive network and we look for motivated sellers. Believe it or not, in bull markets, there are motivated sellers because people run into hardship, and being able to identify those properties where people are motivated, you need to leverage your network. So you must look for property that is open, or for sellers that are open to off-market deals. So you take it away from the competition. We also look for value add opportunities. So in bull market conditions, you usually tend to find that people are so confident that they're not willing to purchase a property that they need to do some work on. They just want a property that has got everything done to it. It's been renovated, etc. So people get a bit lazy during bull markets because their confidence basically overtakes logic. So what we do is we consider fixer-uppers or commercial properties with under-rented spaces for potential capital appreciation through those renovations or rent adjustments. So that is bull markets. Let's move on to the bear market cycle. This is my favorite bear market cycle. Sorry, this is my favorite cycle rather. And why is that? Bear markets are where you get all the opportunities. People are running for the hills, so to speak. Confidence is lacking. And because of that lack of confidence, there's a lack of competition. And you can cherry pick the best properties in these cycles. But there's a trick to doing that. And the trick is, when you have just come out of a bull market or approaching the end of a bull market, the properties that you are in your portfolio that are less favorable to you, those you should look to liquidate so that you've got capital ready and cash ready to execute in the bear market. Easier said than done, but a good way to look at this is through monetary policy elements with regards to inflation and growth dynamics, like I spoke to. Looking at that, you can get a general sense of time when that bear market will hit. If you would like more info on that, drop a comment and I can do a podcast on how we determine the beginning and end of market cycles. So going back to bear market, cash is king. So maintain a healthy cash reserve to cherry pick during bear markets. What we like to do is we select strong rental prospects. In our property portfolio, we have a combination between residential and commercial. The commercial, we look for high cash flow properties or positive geared properties. And these are crucial because when you go into these bear markets, it allows you to stay in the game, so to speak, because you've got all this cash flow that helps out the other properties that have got your negative gearing prospects. It keeps you in the game, so to speak, allow you to hold on to those properties. So it's good to have that diversification. So we will, going back to the high cash flow properties, we carefully select commercial assets with strong rental prospects to provide reliable income even during downturns. We also look for high growth suburbs. We're a data-driven investor. We're professional investors. So we identify residential properties in high growth suburbs with good long-term potential for discounted entry and future appreciation. So do your homework. Look for those suburbs. Look for those assets, because when the market turns, those will have the highest capital appreciation dynamics. And don't forget that having commercial as well, you also get significant capital growth in those bull markets. So use the bear markets to acquire all your assets, as many as you can, after having done your homework and identifying those growth properties with high cash flow. You can get a combination of both because the bear market provides you so much of a less competitive environment. And then lastly is the stagnant market. So this is the cycle where your focus on income generation is very beneficial. So here you need to prioritize properties with reliable rental yields to navigate slow price growth and ensure a steady income stream. If you have these positively geared properties, not only can you stay in the game, which I've mentioned prior, but when it comes to these markets where it comes a little bit more stagnant, you get this good, consistent flow of income, allowing you to build up that cash reserve for your next property purchase. When designing your property portfolio, diversify within sectors. So what do I mean by this? So hold a mix of houses and apartments in different locations, or diversify by commercial asset class such as offices, retail, industrial, to spread out your risk and improve your portfolio performance. If you need help in designing these portfolios, reach out to us. This is our profession. We are professional property investors, and we'll be glad to help you. So this topic of diversification, it goes beyond property types. So you diversify within each sector, such as in residential and commercial. So that's a diversification in itself, and that spreads the risk. And how do we do this? So in residential, like I said, hold a mix of houses and apartments in different locations. Houses allow you to give you a much better potential of value add because you can do so much more to houses. Whereas apartments is a great entry point and a great area for growth because of the high immigration rate into the country. The first point of call that immigrants usually look for when they come into Australia and they immigrate is apartments because they've got lower entry barriers to entry, so to speak. Then in diversification in commercial, like I mentioned, look at a combination of office, retail, and industrial. Industrial has been the darling sector and has had the best growth dynamics. Retail has been the most consistent. Offices probably are looking where you can get the best opportunity if your view is that people are going back to the office market. Offices have taken a huge decline in valuation because of the COVID staying at home work dynamic. But this, we think, probably is coming towards the bottom of this, but it's important to look at the numbers and let this drive you. So in conclusion, you must design a property portfolio that allows you to weather the storm in different market cycles. Market cycles are inevitable. By strategically diversifying your property portfolio, you can potentially navigate both the boom and bust periods more effectively. So to do this, consider your risk tolerance, your investment goals, and capital availability when making decisions throughout these economic cycles. Remember, diversification is a journey, not a destination. Continually assess your portfolio and adjust your strategy as market conditions and your goals evolve. I hope you enjoyed this podcast. If you did, please leave us a like and share a comment. See you in the next one. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.